As investors reach the age of 50 and beyond, the stakes for protecting retirement savings become significantly higher. With less time to recover from financial setbacks, even a single poor investment choice can have lasting consequences. Kevin O'Leary emphasizes the importance of steering clear of particularly risky investments at this stage. By making prudent decisions, investors can help safeguard the nest egg they've worked so hard to build. Understanding these risks is the first step toward ensuring a secure and comfortable retirement. The first type of investment to steer clear of is individual stocks in hot sectors. According to O'Leary, chasing trending stocks often leads to speculation rather than sound financial planning. This approach can be particularly risky for those approaching retirement, as market volatility in these sectors can result in substantial losses. Instead of relying on hype, it's important to prioritize stability and long-term growth when managing retirement savings. Cryptocurrency is often considered a risky investment, especially for individuals over the age of 50. Its value can fluctuate dramatically in short periods, leading to significant financial losses that may be difficult or impossible to recover. For those approaching or already in retirement, such volatility poses a serious threat to financial security. Unlike more stable investment options, cryptocurrencies lack a long-term track record and are not backed by traditional financial safeguards. As a result, experts generally advise older investors to prioritize safer, more predictable assets. High-commission annuities are financial products that frequently prioritize the interests of advisors over those of investors. These annuities often come with steep fees and can tie up your money for extended periods, making it difficult to access your funds without penalties. Despite the promises of steady income, the returns are typically mediocre when compared to other investment options. As a result, investors may find themselves paying more in fees than they gain in benefits, raising important questions about the true value of these products. Leveraged ETFs and options trading are considered high-risk investment strategies. These approaches can lead to rapid and significant losses, making them unsuitable for retirement savings. The volatility and complexity involved often exceed the risk tolerance appropriate for long-term financial security. As a result, most financial experts advise against using these strategies when planning for retirement. Real estate investments can pose significant risks for individuals over 50, particularly when their portfolios are heavily concentrated in just a few properties. Without diversification, investors may be more vulnerable to market downturns or unexpected changes in property values. Additionally, real estate typically lacks liquidity, making it difficult to quickly access cash if needed. This combination of factors can create financial challenges, especially for those approaching retirement. Spreading investments across different asset classes can help reduce these risks and provide greater financial stability. In summary, Kevin O'Leary emphasizes the importance of a straightforward investment strategy. He recommends maintaining a diversified portfolio that minimizes costs and prioritizes capital preservation. By focusing on reliable sources of income and steering clear of unnecessary risks, investors can better safeguard their financial future. This approach aims to provide stability and peace of mind, especially when planning for a comfortable retirement.